Hey folks, it's July 10th, 2022, Sunday in Seattle. I'm Robin Lin and I'm here to share some slides with you again. If you had a chance to look at my previous YouTube, you'll have a base case of what I'm thinking. And today I'm going to be sharing with you some updates so that we can see how some of those crystal ball predictions turned out. So we're talking about Q3 2022. This is my outlook. Of course, we start with disclaimers. So please read through and realize that I am biased. I have blind spots. This is for your entertainment only. This is not investment advice. Thank you very much. So let's get started. I'm going to go through, just like last time, through a lot of slides. We're going to go through them really quickly, but I just wanted to give you a little color on what some of these data points mean. Market update. So the first half of this year saw the S&P 500 drop to the lowest levels in 40 years. It's dropped about 20%. And you can see through this chart, the breakdown of the certain sectors. Year to date, energy is the only one that really did anything good. Everything else did poorly. And of note, if you were heavily invested in a lot of tech, it did much more poorly than the rest of the market. So that's you're probably hearing a lot of people have suffered quite a bit in the first half of this year with their stock investments. The Atlanta Fed does its GDP forecasting all the time. It has now recently forecasted that this next quarter, Q2, it actually went to -2 and recently moved back up, but it's still a negative 1.2%. This is relevant because in Q1, we ended up with a minus 1.6% GDP growth in the United States. So if this forecast is accurate, we will have 2 consecutive quarters of negative GDP growth. It's not actually the official definition of recession, but it's close enough. So what you're seeing is all the indicators, confidence, housing, industrial production activity, retail sales, everything has been moving down. What's interesting though, the last June payrolls unemployment report had a surprisingly high number. So the Wall Street expected a 265,000 jobs created type of number, and we ended up with a 372,000 jobs created. So this kind of surprised everybody on Wall Street who was expecting jobs growth to slow significantly. To dig in a little bit deeper, because this is a kind of a confusing data point, if you compare the establishment survey, non-farm payroll, versus the household survey, you get completely different answers. So the growth number, I said 372,000 of growth. The household survey shows the opposite of the economy, the jobs actually shrinking by 315,000. So what does this mean? Because most of us don't pay that much attention to these job numbers. The household survey is also done by the Fed. They only count individuals one time. So that means if you had multiple jobs, it's not reflected in the household survey number. Whereas the other establishment numbers, you're just counting the number of jobs. And you can see here on this chart, the number of multiple job holders has been pretty high and still at a very high level. So that could explain the discrepancy of why the jobs growth numbers versus the household numbers don't match and why so many people were surprised. I think what a better indicator is actually the jobless claims numbers. So these are data points that are taken every week. And this is pretty clear and probably a lot faster and more accurate, because when you apply for unemployment, that number shows up directly in this indicator. And what you've been seeing since April, the jobless claims numbers have been climbing. And that's been going on for 1 to 3 months now. So this is not a data point, it's a beginning of a trend. We'll see if that continues to go up. But this, to me, is a better indicator of how actually the jobs market in the US is going. And maybe it helps to explain why consumer credit, last time we spoke, consumer credit was at all-time highs. You break that down into revolving and non-revolving credit. Revolving is really something like credit cards. And so obviously when we running short of on our paycheck and inflation is going up and things are costing more, we use our credit cards to pay for it. Well, we've seen that number drastically fall, and maybe that's just people spending less. They're being more frugal and more thoughtful about how they're spending. And but maybe it's also that they're tapping out, maxing out their credit cards, and therefore are forced to spend less. So this is something to watch. I don't know the answer to that, but I think it's important to note that this is a new trend over the last few weeks. Overall, no surprise, the real wages, meaning your wage growth minus inflation growth, it's been negative since the beginning of the year, even actually for the US, even earlier than that. And then here's the UK and the US chart. It's not a surprise that because of stagnating wages, we're starting to see a lot of labor issues and protests, and excuse me, people being quite unhappy, which makes sense. The miserability index is climbing all over the Western world for sure. And the US University of Michigan consumer sentiment chart is now lowest on record, which is pretty stunning. This is an index of the National Federation of Independent Businesses. So we consider that the small business index. That's not looking very good either. And when you see these little red shaded areas, those are recession areas. They're a pretty good indicator of what's to come for the economy. The PCE inflation index versus the CPI index. The PCE is the preferred inflation counting method of the Fed. The point being, it's still high. It's come down a little bit for when you just take out energy and food, which makes sense. But the broad headline consumer, personal consumer expenditures index is still quite high. This is very interesting that, excuse me, when we're looking at Treasury yields, these are Treasury bonds, the 2-year Treasury bond, the 5-year, the 10-year Treasury bonds, they're all yielding about the same. So that doesn't make sense in the normal world. If you're lending money to a friend for 2 years versus 10 years, usually you want to get more if you're lending for a longer time. So the 10-year should be giving you a better payout, right? Because you're taking more risk, more things can happen in 10 years. Why does it end up being that now people are bidding up and all of these are the same? This is kind of where the yield curves are flatlining and maybe inverting. And this is a very important indicator for economists, because it's basically saying, I'm not hopeful of the future. I think inflation might be high, or there may be trouble. So I'd rather lock in a long-term bond and get that certain yield rather than taking other risks. So this is a very important indicator that everybody should start to learn to understand. And when these yield curves invert, this is the 2 years versus the 10-year yields. When the yield curves start to invert, again, it's a very, very accurate indicator of recession. Now, with the Fed raising interest rates because of inflation, they raised to 0.75 in June. Highly likely they'll raise another 0.75 in July. So the Fed told us with their dot plot chart that they're going to raise the interest rate probably around to 3.4 to 3.8%. So that's kind of what the US markets are reflecting in the 5-year inflation break-even and bonds. Recently, it's dropped to 2.51, which is very interesting, because why would that happen? Why would we think this inflation thing is going to drop? There are a couple of reasons why people think this. Do they think everything's temporary and we're going to get back on track? The economy is going to start growing again, so we're going to have those issues under control. That could be one answer. The other answer that is circulating probably in the financial markets is that, is the Fed going to raise interest rates so hard and slam on the brakes of the economy so hard that they're going to be actually forced to lower interest rates again? Are they going to be forced to restart all the stimulus and the QE again? That's in many circles, that's their forecast, that sometime next year, the economy is going to suck so bad, the Fed is going to flip and start jamming the gas pedal and lower interest rates. So that's starting to be reflected in these longer term charts. So keep that in mind. Now, basically, no surprise, around the world, the US is in a pretty good position because we have food and we have energy. It's not the biggest component of our consumption basket. However, around the world, you see in the EU, Latin America, and Asia, food and energy, they make up a huge portion of what people spend on what their paychecks are, which could be very, very dangerous for countries that don't have access or cannot grow enough food and energy. No surprise, high commodity prices boosts inflation. Commodity importers do better than suffer more than commodity exporters, but even exporters suffer from inflation. This is, I think, a very interesting chart. I've never seen this chart, but floating rate. So of the different countries in the world, what percentage of their mortgages are adjusting floating rate mortgages? The US is relatively low. We have a lot of these fixed rate mortgages. And so we're actually more protected from a lot of issues. But countries around the world, wow, I mean, look at Poland or even Japan. Mortgages could suddenly shoot up if the interest rates start to rise high in order to fight inflation. So that could be a huge financial burden that hasn't quite hit yet. Okay. In the US, we're seeing the housing inventories really climb compared to the last few years. So it's an indicator that housing markets are slowing. People were, maybe it's because the higher mortgage rates or just high inflation, people have less money. The appetite for buying housing and the crazy house prices that we experienced over the last year, they're starting to slow significantly. This is a very interesting chart also. I find this kind of fascinating. The light blue is the S&P 500, and we've dropped a lot already. And the dark blue line is the forward earnings estimate. And what's weird is you look at this thing and it's going and the prices in the market have come down, but these earning estimates are still staying relatively high. It means that Wall Street analysts still think that a lot of these companies are going to be able to continue growing their sales, growing their earnings. And I find that highly suspect. I think this is going to bend, kind of like over here. But the point being, the prices of the market are reflecting actually a relatively healthy earnings outlook. What happens if earnings start to move down? Does it make the pricing chart drop more, or is that already priced in? So this is a mystery. We got to watch to see what happens here. Quick update on Europe, and I pick on Germany specifically. They're a lot more easy to access charts. Germany's trade balance is now gone back to terrible. And mind you, Germany as an economy, they are like 50–60% dependent on exports. So once their exports don't kick in, their economy really suffers. And Germany, their number one trading partner is actually the rest of Europe, and then of course Asia and the US. So it means that whatever they're importing, maybe energy prices have gone up, all those things have gone up. But the exports are not keeping up in value. So this is a huge concern for Germany. Weird, Germany's imports from Russia, hey, Ukraine war, if not anything, it probably accelerated their imports of things from Russia, primarily oil and natural gas. Why is that? Weren't the Russians, weren't the Europeans sanctioning Russia? In reality, they have not when it comes to energy. In fact, they've been trying to hoard as much as they can, fill up their storage units as much as they can in preparation for the winter. In fact, they went as far as even saying, hey, Russia, we're going to gradually reduce imports from you, but this year we want to raise the storage targets so that we're going to be safe in the winter. In the meantime, energy prices in Europe, here's Germany in particular, last year they were paying around this level, and now they're paying 6 times that for their electricity. So this is a huge shock and a huge cost burden for not just individuals, but also every company and industry in Germany. So it's not strange to see that Germany is now trying to figure ways of saving energy. So Germany's largest landlord is now planning to cut heating power so that you can only heat up to 17 degrees Celsius, which is about 62 degrees Fahrenheit during the evening hours. And some cities are already planning for dimming the street lights and other things to start save energy in preparation for what could be a really challenging winter. So rationing of energy is going to become probably a common thing throughout Europe. Okay, the Eurozone inflation has climbed like anything else. Interestingly, their central bank has not done anything. So their interest rate is technically a negative 0.39. Christine Lagarde, who is the head of the ECB, they've discussed and probably will start implementing interest rate hikes this summer. My concern is it too little too late. I mean, this gap is so huge. And by raising interest rates, again, think of that as jamming the brakes of the economy. It's a very, very tricky issue of how far do you jam the brakes before you cause a recession or even a depression. So this is a very, very abnormal situation. It looks like a very painful situation, and we'll have to see how all that plays out. So let's jump into the inflation question. We've obviously experienced inflation over the last few months. What's interesting though, commodities have lost about 20% since the peak in June. So beginning June, it was at a certain level and it's just dropped like a rock. What does that mean? This is the commodity index. So this is all commodities, it's energy, agriculture, metals. If we break that down into, say, some energy, this one specifically is wholesale gas prices. In 1 month, it just dropped a lot. Similar for agriculture. This is corn. This one is soybeans. Excuse me. And here's copper. Also dropping a lot. 20, 30%, drops, which is pretty stunning. So here's the question: why did it drop? Why did it drop so precipitously? Part of the reason is that beginning of June, I think a lot of the investors in the world suddenly realized, holy smokes, recession is a real threat. It really could happen. And when recession happens, the typical playbook is saying, yeah, then demand for all sorts of things will collapse. And so we're going to drive less and we're going to eat less or something like that. We're definitely going to build less. Those are the thoughts and the ideas that are in Wall Street. And I think that could be one of the main reasons why we saw this precipitous drop, where you probably, if you invested in those things, you take some profit, you did well, you kind of lock in those gains. and then it can snowball as the prices drop more and more people sell and lock in gains, and then it kind of goes in that direction. So the question now becomes with that now priced in, is a recession in the books? Does that really mean that these commodity prices are now at this level or even going lower? So let's dig into that a little bit and look at where some of these commodity fundamentals are today. So here is the U.S. Drought Monitor. That was in June. This is July. Still doesn't look really good. If anything, the yellow areas of the dry areas have expanded. These are recent pictures of Lake Mead, which is in this area. It's drying up, and everybody in Nevada and the surrounding states is concerned. It's like, oh my God, what do you do? Are we going to get rain? The water level is now at one of the lowest, if not the lowest levels in decades. If we look at the forecasts of the future temperatures, hopefully we get some more rain, but what I'm seeing is, the breadbasket, the crop area is here in the middle. So the northern parts are still kind of challenged for precipitation. So we'll have to look into the crop outlooks in the next couple of weeks to figure out if there's a real crisis. So way back when I shared with you the May 15 US crop progress numbers was pretty bad. We were behind pretty much on everything. Today it's improved a bit. On July 3rd, we're seeing, a little bit better, good to excellent numbers. It's not as horrid as it was originally forecast, but it's still under stress. So we'll have to continue monitoring all of these developments, as getting rain at the right time or having too much rain at the wrong time is all really challenging for farmers. The U.S. corn situation, this is the latest in July 3rd. Overall, the good quality of the corn has been reduced about 3 percentage points, meaning certain states suddenly had perhaps bad weather, so the progress is poor. Similar for soybeans, it's actually fallen since the last report, also due to weather. Canada, they decided to plant more wheat for 2022. So we're going to see more acreage dedicated to wheat. Canola, we mentioned that their canola crop was looking weak. Looks like that's pretty much baked in, that they're going to plant less. However, they're planting more wheat, but the grain stocks of what they had of total wheat was drastically reduced. And it means we're eating through that stock, and the new crops that we're planting now, yes, we grew the acreage, but I don't know if it is able to make up for these huge drops in stock levels. So again, something to be concerned about. Europe, I don't have any good charts, but Europe also is in a heat wave. And South America, I don't know the updates on the weather there. As far as energy is concerned, we've had a couple of new developments. So one of them is that the US, we only have like 8 liquid natural gas export terminals in the US. And there was a big fire in one of them at the Freeport LNG terminal. So originally they thought it would take about 3 weeks to fix it. Now they say, no, it might take quite a long time, maybe into the fall. And meanwhile, Russia has decided to say, hey, we have some maintenance issues with the Nord Stream 1 pipeline that pumps all the natural gas specifically towards Germany. They have since reduced their the capacity by 50%. So Germany is in a funk. They're very stressed and they're very worried about, what's going to happen? Can I fill up my storage tanks in time? And also, what if Russia is just going to play games and shut it off. What do we do next? So what you're seeing is, sorry, here's all the export LNG terminals in the US, the red dots, and here's the Freeport one. Yeah, that's an issue. And it's not a huge volume because it was a relatively new one, but this is the how much we export, and this is an old one. This is from 2019 also. So again, going back to the EU natural gas prices, the Freeport LNG fire, and then they confirm that it's going to take a long time. And then Russia saying, whoops, we're not going to, pipeline issues, maintenance issues, cutting down exports to Europe, especially Nord Stream 1. EU natural gas prices just, hockey sticked up. And what happened is, because of the Freeport export terminal not being able to export, it actually means there's a little bit more natural gas in the US. So US natural gas prices actually dropped, and is climbing a little bit, but that dichotomy of what happens of who is exporting, how much you're exporting, it's changing the prices dramatically. Deutsche Bank says July 22, that's a crucial date to know. We'll know then if Russia is going to restart pumping natural gas to Europe or not. If they don't, yeah, Europe is due for even higher natural gas prices. And this is an old chart that I showed last time, but this gap is just nasty. It's not easy to fix. Europe has serious challenges ahead if Russia cuts off natural gas exports to Europe. So, okay, and yeah. So, being good Europeans, they've now all banded together and decided, wait a minute, we want to be green, and now we're including natural gas and nuclear as green investments. So in the past, they pretty much poo-pooed all that, and they really wanted to go with maybe natural gas and a lot of the alternatives like wind and solar. Now they've added nuclear. This is not going to make Greta very happy, but this is practical, and Europe is faced with a real harsh winter and energy crisis that could be quite debilitating for their economy. Meanwhile, in the US, we are currently experiencing a heat dome, and that is driving energy, air conditioning costs and energy demand higher. So this is ERCOT, this is like from Texas, the actual demand curves, and prices. So every time we get a heat wave, this is likely to happen. Every time we have cooler temperatures, the demand drops and prices drop. So it's a very, very volatile, and it's very climate dependent. And, for what it's worth, I've shown you the climate forecast for the next, couple of weeks, but who knows, okay? And we'll have to keep watch on all of those developments. So anyways, that was primarily natural gas. Now let's talk a little bit more about crude oil. These are great headlines, just like a couple days apart. JP Morgan's worried that oil prices are going to shoot up to 380. And Citi says, no, recession, demand slowing down, it could fall to 65. Which way is this going to go? That's a great question. Last time I shared with you this chart of energy, crude oil inventories and production. Here's now an updated one where at least Goldman Sachs believes that we're not going to fix this in a hockey stick manner. It's going to take quite some time, sometime into mid next year before crude oil production and inventories are going to track back to a more sustainable level. When we look at that, here's a chart of what OPEC plus their output. So OPEC is the oil cartel, Saudi Arabia, the Middle East, all these guys get together and kind of agree on production volumes and prices. I shouldn't say prices, production volume, and they want to influence the prices. Well, the point being here that since May 2020, they've been underproducing oil. They have not been able to produce enough to meet the demand. Is this on purpose, or is this for other reasons? Great question. We'll never know unless you've got an in with the Saudi oil minister. But suffice it to say, there are other countries in OPEC who are facing issues because of maintenance, because of wars, because of this and that. So those producers have been facing issues where they just can't produce enough. The other concerns that the oil industry is looking at is, Saudi Arabia says it has this much oil reserves and that they can tap it anytime. Well, those data points have not been updated for 20 years. So now there's a question of, do they really still have those reserves? Because we've been drawing them. How could they be maintained at the same level? So there's that question mark. And then, of course, the geopolitical question of, if you control the oil, you have leverage over all the oil importing countries, including the United States. President Biden has really had to bow his head and make a trip to Saudi Arabia, specifically to the son of the Sultan, who he accused of murdering journalists and basically putting him on a blacklist. And what's been interesting is President Biden has really had to go to countries we've deemed unfriendly or don't like Iran, like Venezuela, like the Saudi Arabia, and has really hat in hand been asking them to start producing more and getting their oil onto the markets. So long story short, OPEC in the Middle East, they're not producing what they promised or expected to produce. And this is a huge issue that it could swing the markets either way. But as far as I can tell, it feels like there's more a capacity issue where they can't produce more, rather than a group of people saying, let's just not produce more and make oil prices go higher. Historically, that's backfire. Once that happens and people get wind of it, bad things happen and they don't become a credible supplier. So this could be actually a more secular reason of why OPEC is not producing enough and the world is just going to be short. Here's another game that Russia is playing also. They have pipelines that they run from oil producers in Kazakhstan through the Black Sea and into Europe. Well, they said, hey, you Kazakhstan crude people, you violated some spill prevention plan. We're halting production through or transport through our pipelines until you fix it. And this is amounting to roughly 1 million barrels a day of crude oil that typically would have gotten to Europe, but now is being bottlenecked due to regulation. So this is a very clever play, I think, by Putin to further squeeze Europe. Here's a very interesting chart that most of us really don't understand, except for the oil exports. I'm not any expert, but understanding the mentality. What oil companies in the US do, they often get a piece of land where they get a permit and then they start drilling. And they may drill and then found, hey, COVID, we don't need to produce that. We can't afford it. We're just going to drill it and then top it off and not drill it, not produce out of it. And then what happens is, recently we need oil. We want to produce more oil because oil prices are high. So they go back to those oil wells that are drilled but not completed, and they open them up and then they try to produce from them. Well, now the number of drilled but not completed oil wells has fallen to a really, really low level. And for that reason, it now becomes a question of, do these oil companies say, yeah, the demand is there, the prices are high, I'm going to go and find more land and go and drill new wells and try to produce that. That's very costly. I mean, obviously having a pre-drilled well and just opening it back up is a lot faster and cheaper. But will these oil companies, these energy companies, actually spend the money to do it? My guess is not yet. Biden has been very talking tough and essentially blaming the U.S. energy industry for gouging, quote unquote, gouging American consumers and keeping their profits super high and making everybody suffer. On top of that, when Biden took office, there were policies and mandates to shift away from fossil fuels towards greener energy, and those policies are still in place. And so for the energy companies, the energy CEOs, they're not highly incentivized to take risks right now. Right now, what they can do is basically reap the profits that they invested in, and this market is going to keep paying them well because we need this energy. And because the risks are, you spend billions and billions of dollars that you need to make back over the next 10, 20 years. Well, if the outlook over the next 10, 20 years is down, it doesn't make for a very good investment. And so they're not highly incentivized to budge too much and go high risk to develop more production in the US. So this is something to watch to see if the government, if Biden changes policies, tries to incentivize their behavior to actually drill more. Otherwise, they're going to probably just sit and be happy and collect a lot of money. And, to be fair, they did this 10 years ago and drilled a lot. We did a lot of the hydraulic fracking, et cetera, and really boosted production. They didn't make money off of that. They're only making money now. A lot of smaller companies, in fact, probably were in the red. So now it makes sense that these companies, the CEOs, want to finally receive their payouts. Anyways, suffice it to say, the US is not rapidly trying to produce more. It has a lot to do with these economics. Also, the fact that equipment, materials, the sand for hydraulic fracking, all these things are difficult. There's a shortage of labor, the prices are higher. So it's a much more complicated issue than many may understand. Meanwhile, Russia is exporting more crude than ever before. The US has stopped importing. The EU has cut a lot of their imports, but a lot of other countries have boosted their imports of Russian crude. I just found these charts fun to look at. Who's still buying from Russia? Germany #2, Italy #3, Netherlands #4, Turkey. Basically, Europe is still buying in bulk. Who's not buying from Russia? US is 100%. This is very deceptive because US didn't in actual volume or dollar numbers, it was never that big. But these are the countries that have been either targeted by Russia or have been adamant of supporting the Ukraine and have been helping or trying to wean themselves off of Russian energy and dependence. Just a quick forecast of operating margins for the US energy sector. Up and to the right, free cash flow compared to the S&P 500. Up and to the right. Oh, not just S&P 500, but S&P 500 tech. So all those software companies that have very little cost and have 50, 100% profit margins, the cash flow from the energy sector is now, wow, significantly higher, even than tech. Here's just somebody's analysis of what they think is valuable. Enterprise value divided by cash flow. Basically, it's saying these companies are cheap and they deserve to be up here. So there could be still a lot of room for these energy companies to go up in stock price. Okay, so just to give you a little bit of the investment fundamentals to consider, energy could still be a very attractive investment. Nothing really here to add, just quick updates on China. They have unlocked down lots of the country, and people were very angry, and the economy slowed dramatically. So of course, here's a new $220 billion stimulus package that they're trying to push through. It will take time for that to actually show up in the economy, but the stock markets are starting to reflect a little bit of that hopium. Having said that, China has reiterated that they will continue to do COVID lockdowns in case of COVID outbreaks. And the latest lockdown is in Macau, where there was an outbreak in a casino, and now all of the casinos are locked down. Luckily, this doesn't have much impact on production and exports, but it goes to serve as a notice that this could happen at any time, and it could again disrupt the supply chain, production, economy, shipping. This could pop up again at any time. And just as a reminder, China is very dominant in certain things. All our clean energy metals are processed in China. All our antibiotics, I shouldn't say all, but a huge majority of them are made by China. Here is China's influenced the soybean meal prices because they didn't have enough pigs. They had swine flu, destroyed the pig population, and they're rebuilding that. So these are just interesting little tidbits for you to consider. It should mean that soybean meal demand and imports to China should increase over the next year or so as the hog population reconstitutes. So now let's get to what the governments are going to do. Basically, the Fed and the central banks around the world are facing high inflation everywhere. And that means they're raising interest rates everywhere, or they haven't done anything at all. So yeah, the green is where they cut. The last time they cut were in 2019, 2021, etc. But the hikes are all relatively new, June, July, May of this year. So around the world, central banks are increasing the cost of borrowing money. They are hitting the brakes on the economy, causing the economy to slow down. When we look at just the monetary base in the US, this is a growth curve, so it looks much more dramatic than the actual dollar money amounts. But the direction of these is very important. And when you look at a negative US dollar money base growth, this has impact on all sorts of investment. Any kind of risk asset investment will be influenced by this liquidity indicator. So we kind of went through this already. Skip. Yield curves are inverting again. Here's the Asian currency DXY. So the dollar, when we say the dollar is getting strong or weak, it's usually against a currency or a basket of currency. So when we typically say the dollar is strong, we're talking about the DXY, and the majority of that is actually against the euro and the yen. But if we break it down just to the Asian currencies, we're still seeing the dollar being extremely strong. And and here is the euro dollar curve, where it used to be, all the way up here, and the dollar has gotten stronger and stronger and stronger. We've pretty much essentially hit parity, where $1 US equals $1 euro. So for Americans traveling to Europe, you're getting a huge discount because you're paying for things at a price that is appreciated. This is the dollar Chinese yuan curve. The yuan strengthened dramatically last year, and only because of the lockdowns, COVID lockdowns, beginning of this year, that we've seen it weaken. So what's interesting to note here is this, I'm not a technician, but this chart looks like it's, a little flag, a pennant. And that typically means that in due time over here, it just breaks up or breaks down dramatically. It doesn't just hover around sideways. So it'll be interesting to note how that goes. So to recap, my base case from last time was the Russia-Ukraine things are causing structural commodity scarcity. We've had supply chain disruptions in China. They've since opened up a lot. They're working through the backlog. However, that's still in process. It still takes some time. I think we're still facing pretty high inflation. We're going to see by the fall what agriculture prices really will turn out like. You're seeing countries around the world really suffer. You're seeing protests, yellow vest protests all over the world. And as this inflation is still prevalent, the central banks and the governments are raising interest rates, slowing the economy to try to combat the inflation. So I don't see any changes to this situation now. Adding a quick talk on crypto. I thought this was interesting. Coinbase is a US crypto exchange, and you see that institutions have really become more involved in crypto. Having said that, crypto prices have come down so much, and for investors, it's still a very small percentage of what they're invested in. But this is very interesting that institutions have stepped up and added crypto as an asset class that they're seriously considering to invest in. So the prices of crypto, Bitcoin and Ethereum have completely just dropped since the beginning of the year. Right now, Bitcoin's probably around $20,000 Bitcoin. Some people are charting it. Don't know. Again, we're seeing these pennant kind of technical patterns popping up. And come this summer, do we see this causing a rebound in crypto, or is it going to fall to the next level? Now, ways to look at Bitcoin, I think, that are really interesting is if you map the adoption rate of Bitcoin against the adoption rate of the internet, which is the green line, or mobile phones, which is the orange line, you can see that the adoption rate, the curves kind of track. And it makes sense as long as people keep using cryptos and Bitcoins in the world, more and more people are signed up or adding money to it, these prices will probably continue to follow that curve. I'm not going to go into a lot of detail here. This is just for your review and thoughts. This guy at Fidelity thinks that the curve looks more like the internet curve and not the iPhone, smartphone curve, which is fine. And over time, you can see that it could level out, but then the price levels would be around there. Let's skip over that one. And then he did a thought experiment and compared it to valuation levels. And basically his conclusion was right now with this gap, Bitcoin is actually not expensive. It's relatively cheap. And if Ethereum were really just mapping the curve of Bitcoin, and the black line is Ethereum, but 4 years off, it could be even cheaper than Bitcoin relatively. So there's another fun chart that somebody drew up again with the idea of, slow, fast, medium, adoption rates and estimated prices. You can see from this chart that nobody knows. This is a complete mess and not a useful chart, but I wanted to show that people spend their time doing this. Here's another way to look at crypto, specifically Bitcoin prices, tracking it against year-on-year growth of M2 money supply. And I personally like this concept a lot, that when the money supply is growing and is available, when there's lots of liquidity, it's easier to invest in risky things. And as this money supply and growth rate comes down, it's not a surprise that these risk asset prices come down. Okay. So to sum up, this is the same crystal ball slide that I had from my last presentation. I don't believe anything's changed dramatically. I think the prices of everything remain high and sticky. Bankruptcies, you're starting to see them pop up with small companies, and hopefully no big ones, but this is starting to happen. A lot of the weaker companies that are not cash flow positive, who have debt, are starting to fold. I believe unemployment will rise, even though the June payroll numbers were actually quite strong. I think the jobless claims is a better indicator, and then sometime late this summer, we're probably going to see some of those data points reflect labor weakness. Scarcity economics, high prices is already creating more and more social unrest. So if you look around the world and pick up the news from different countries, you're seeing people really, really unhappy, even on the brink of civil war, revolution. You're seeing that already in Sri Lanka, and there are a lot of countries in similar situations. Long war, I don't see anything yet that would indicate that Putin is ready to negotiate and call for a stalemate and try to keep things tamed like that. What I see is Europe is facing a challenging winter, and Putin has absolute control over whether or not Europe has energy to heat their homes or not. This is really causing grief and strife and division, I think, within the Western Alliance. So again, that would be the way that Putin can get everybody to bend a knee and accept him and accept his prices, accept his way, in order to keep the lights on and the heater on for the winter. I think Putin will continue on with this war and with his rhetoric, and try to force the West to appease him. And the deglobalization trend, I still don't see any changes to that trend. There's going to be some negotiation with China. I think Biden has toyed with the idea of reducing some of the tariffs that Trump put on China. So far, it sounds like it's not going to be a big chunk anyways. And there's quite a lot of resistance, especially from his team that wants to negotiate hard with China on other matters. So we'll see how that plays out. Looking with a little bit of a finer scope, I do think the Fed is going to raise interest rates in July at the 0.75 level. And since unemployment is still at 3.6, which is really low, they have room to keep raising interest rates to fight inflation. So I think come September, they're still going to raise interest rates, maybe a little bit less. And if the inflation rate and specifically the unemployment rate are still low in September, or I should say the unemployment rate is still low in September, they may continue raising interest rates to the rest of the year. I do think that by measurement, remember all these inflation numbers are percentage rates comparing a previous number to the current number. I think we are probably peaking out with PCE inflation rates based off of year over year increases. But it doesn't mean that prices are coming down. And that's the important factor, that for the average Joe, you're still paying $4 or $5 a gallon for gas, even if the official inflation numbers have peaked out or started to come down. We're going to just be paying those prices. If catastrophe happens, and as I surmise, the energy prices spike back up, or food prices spike back up because we've eaten through our inventory and then the inventory levels aren't replenished, we could still see food and energy costs show up in force this fall and winter. I think that the Q2 earnings, they're going to start next week. And I believe that we're going to see earning forecasts that are moderating or being reduced. And I believe that Wall Street, I had shown you the forward earning curve forecast. I think that curve starts to dip down, and that should cause a repricing of the market. It should cause a repricing of what we think the stock market value should be. And I would expect a lot of price volatility, and maybe we get another kathunk down in the stock market. Could happen. Yeah, volatility this summer. Widespread social unrest. I think that's just going to keep increasing all over the world through the year. Let's see. EU, I feel highly confident they're going to face recession this year. The US, we've had the first quarter already bad. Second quarter could be negative. I don't know if we're officially going to be in recession, but if we do, it should be in the beginning half of the year. And my framework is also this. I mean, Q1 of 2022 for the US being at minus 1.6%, that was before the Ukraine war and all the disruption and commodity inflation. So we were already slowing down before all of that happened. Okay, and now since then, since May, we started really jamming the brakes on the economy by raising interest rates. So these two factors, that the economy was slowing and then we're jamming the brakes in between and trying to make it go slower, quicker, it could mean that we get over the worst part of this earlier than the rest of the world. So I would expect this summer, this fall, the US economy, specifically the fall, winter, maybe we start to bottom out and start to find a way to hope for a recovery of the economy. So let's see how that plays out. China, I don't think their stimulus gains traction into the fall. This is critical because they have their big powwow and try to re-anoint Xi Jinping for another term as the exalted leader. I think that plays out as you're seeing some movement in the Chinese economy. At least the stock market is looking a little bit more hopeful. And if that all plays out well, then he'll be reelected for another term. And hopefully, if the vibes are good, then they don't feel the urge to do anything nasty to Taiwan. If things fall apart in between, as I mentioned before, they may need to do something to rally the troops and create more patriotism, and then do something to Taiwan that is offensive and aggressive, but won't trigger a full Western response. So my speculation is China could just quickly take over a couple of islands that Taiwan manages, like the Kingman Islands or something like that. Populations there are like 100,000. They're military there, but that would be easy to take over because they're so close to mainland China. And probably that wouldn't trigger anything other than condemnations from the West, but not like a military response. Anyways, that's random speculation. Ukraine war, I think, is just going to be in stalemate, and I think Democrats are really in trouble in the midterm elections. Okay. As I mentioned, Yellow Vest protests that started in France in 2018 just because of energy prices and wages. They are revived, and I think 2022, we're going to see a lot of that. South Korean truck drivers, you're going to see, many countries face this. Sri Lanka is basically already defaulted. Their first president already resigned. The second president, they're firebombing his house. He's going to resign. It's a really bad situation. So when we look around the world, we see a lot of countries in challenging situations. When you look at the debt of these countries in particular, these are their payment schedules. They're supposed to pay back one of their treasury bonds at this time and this amount, and at this time and this amount. And right now, with the dollar being so strong, with the economy slowing so significantly, could they default sooner rather than later? These are the top countries that have been highlighted, at least by Bloomberg, of having the highest risk. And around the world, here's another chart of something similar. South America, Central America, naturally Africa, parts of the Middle East, Pakistan. These are all under severe stress, and hopefully nothing happens. Okay, this is about all I wanted to share. Again, I kind of ran over on time. Remember, don't panic. We got this. You can take care of it. You know what could be ahead, so just get prepared. Keep calm, be prepared, and listen to me every once in a while. And if you have any thoughts or questions or anything like that, you feel free to reach out to me. I'm on Twitter, and you can email me as well. Okay, that's all for now. Be safe, enjoy, have a great summer, and I'll be back next quarter. Thanks.